Here in God's Zone, the housing market doesn't reward the sensible, it rewards the leveraged, the bold, and the morally flexible. Housing prices are down 0.6%, so today we ask, is this the bottom? Is 2026 going to be the comeback tour of the housing cycle? Everyone's pretending this isn't a market pause. It's a coiled spring, and either you're riding it or getting trampled by boomers and Range Rovers. BNZ Chief Economist Mike Jones returns. Is the New Zealand property market quietly resetting for a 2026 boom?
Financial freedom faster. Financial freedom faster.
If you're still waiting for the right time, you might want to check your watch. It's already happened. The MortgageHQ Snapshot has been the wake-up slap for thousands of Kiwi investors who got off the fence and into the market. It's blunt, sharp, and sitting in the description. Take the shortcut before the next wave leaves you in the shallows. Mike, is this the bottom? Has the New Zealand housing market finally hit reset? Or are we just pausing before another leg down?
Well, is it the bottom? I think it's probably we've been bumping along the bottom of the housing market for almost a couple of years now. I mean, I think technically speaking, if you look at the bottom in house prices, they were reached sometime mid to later part of 2023. But what hasn't happened is that prices haven't kicked up again. They've basically been trundling along sideways ever since. Although if you're in the South Island, you'll beg to differ, where prices have actually returned pretty much to their record peaks. It's just the rest of the country where we haven't seen a lot happening. What's been happening a little bit more just recently is there's a bit more activity in the market. So there is more buying and selling. We're seeing turnover pick up. So there seems to be a bit more interest to transact. It just hasn't put the same pressure on house prices like we might have seen in some of those past cycles.
Is 2025 the perfect storm for investors to buy?
We've seen a bit more investor interest. You can see that in a number of indicators around, whether it's some of the data on who's transacting or the lending figures. So there's certainly a bit of interest there. There's obviously some headwinds, on a cash basis for investors as well, which we're hearing a lot of, whether it's insurance, whether it's rates, maintenance, etc. So there's definitely a dipping of toes back into the market, but nothing like we might have seen most recently, I suppose, 2020, 2021. And you'd have to say that even outside the property market, there is the sort of general malaise of the economy is playing into some of that as well, where things are just not kicking on, perhaps as people like me had forecasted and hoped. And you tend to see the property market, the housing market, and the economy move in sync. And at the moment, they're kind of moving in sync sideways.
Why has it not been to your expectations, do you think?
Well, look, we are in a recovery. I think we've had a couple of quarters of reasonably good, reasonably positive economic growth. I think the middle of the year, though, we've definitely seen a sag. We've seen a loss of momentum, and there is a narrative that says, well, maybe it's because interest rates haven't fallen enough, the Reserve Bank hasn't cut enough. No, I think lower interest rates are working in the economy. They are providing some support and stimulus. I think in part what's happened is other things have come along and blown in the other direction. So whether it's the chaos we saw in April with tariffs and so forth, trade disruptions, other shocks or negative impacts, whether it's kind of cost of living hikes, food prices rising, or something like that. But things have come along that have tended to offset some of those impacts from lower interest rates. So I think ultimately,
I would say though that around that winter period, it is flat, the market. Normally over the last couple of years. So we shouldn't be that surprised. Inflation's under control. The interest rates are falling. Does that mean, though, we are looking towards a boom in 2026? And I say that boom, not in the 21 style. I say compared to what we've had over the last couple of years.
Oh, look, I mean, our forecasts are for not a lot of growth this year, so 3% odd, which probably feels closer to flat, the way things are going at the moment, and then about a 5% lift next year. So that's at or probably still slightly below the average, the long run average for a annual house price increase. And by the time you're talking about a year and a half in advance, I mean, the uncertainty around those numbers is
So could I say to you then, if it's 3 to 4% and inflation's around about 3%, are you being optimistic, pessimistic, or realistic about this?
well, we try and be as realistic as possible when it comes to a variable that's inherently difficult, or in some cases impossible to forecast. So, but I mean, the reference to an inflation-adjusted number is interesting, because if you look at inflation-adjusted house prices, real house prices, whatever you want to call it, they're still down 20-25% from that peak. And if you run our forecast for both inflation and house prices, I don't think there's an expectation that you'll get back to that peak until quite some years down the track. Now, of course, no one knows what actually happens. Things change. But as a base case, you're talking about a very low and slow recovery.
Now, I noticed in your report that real estate job adverts are up 7%. What do you interpret that as? Is that because there are incompetent real estate agents out there and they can't find the houses? Or is that licensees who are actually trying to get more people in because there's going to be a boom?
I think it's a genuine sign of more activity in the market, more turnover. That's one of the things that's probably going to inject a bit more oomph into GDP growth, and how they measure it is that, as I said, yes, house prices aren't doing a whole lot, but there is more buying and selling, more turnover and activity, which means there's obviously more work for agents, more work for lawyers, maybe a little bit more, retail purchases of furniture and whatever else, all that stuff that tends to go with a rising pace of house sales. And so that's, I think, what's being reflected in those job ad numbers.
I'm inclined to understand that the top 20% of real estate agents make 80% of the sales. So, and when you're in a bust like this at the moment, your real estate agents who aren't actually that good are just struggling to make money.
Yeah, may well be the case. I mean, if you look at sales where they are now, they really only got back to, and this is national house sales, they've really only got back to about average. So that, we're looking at, I think, somewhere between 6 and 6,500 a month, which is still, I think we got up to peaks about 9 to 10,000. So you're still looking at a market that's recovered, but it's hardly racing away.
So rents are holding steady and mortgage costs are falling. Are we about to see the return of cash positive unicorns in housing?
Well, rents is interesting, and we did talk about it a bit in a note of a couple of days ago, because the capacity or the extra supply in the rental market still seems to be large. And so rents, if you look at how stats measure rents and the CPI that came out the other day, well, they're still rising about 3%, but over 3% on an annual basis. If you look at, and that's the stock, that's the, all rental properties. If you look at new rents, so newly agreed tenancies, which tends to be a more market-driven measure, I mean, those rents on those tenancies are falling at about somewhere between 2 and 3% year on year. So it's telling us there's still more supply in that rental market than there is a kind of marginal demand at the moment. I think we've talked before, about some of our research about that excess supply, and it seems to be bearing out now in those new rent statistics.
We have spoken on the show quite a bit to you about the South Island. Are those the regions still that we can see a lot of growth in the next 6 to 12 months, particularly Canterbury and Otago? I think
Canterbury. Yeah, I mean, that story, that narrative of South is better than North, I mean, that's been running now for 18 months. And taking a bit of a look at the numbers just recently, I think it's probably getting close to kind of peak divergence. We should, and already actually there's some signs that Otago is just sort of losing a little bit of its edge. I think Canterbury, still kind of top of the pops, still going really strong. Look, it's going to get more and more support from these very strong primary sector revenues we're getting. So I think the story's got a bit more to play out. But I also think, if we're all serious and thinking about this economic recovery, well, you're not going to have a proper recovery unless you get Auckland and Wellington and the bigger urban centres coming to play as well. So I think that, for me, is really the thing to watch from here, is just when you get not necessarily those urban centres, they're a long way from overtaking, but just chewing up a bit of that divergence that's opened up over the past 18 months, which probably requires some of that primary sector revenue and cash to be invested and spent around the economy and make its way from the regions more back in towards the urban centres.
Yes, I think what you're trying to say is that the elephant in the open plan living room really is confidence, which we still don't have in New Zealand right now.
Yeah, it's a funny concept. I mean, look, you get surveys of it, and we got one today where it says actually firms are still keeping the faith. They're saying that their own anticipated activity over the coming 12 months is going to be a lot better than what it has been. Now, some of that we've always said might just be the firms going, well, it couldn't get any worse than where it's been. So naturally, next year we expect to be better. But going out and about and talking to businesses more face-to-face, you don't get the sense that there's a whole lot of confidence out there. We're still wanting in that regard a little bit. I think we were probably getting there, but then we had some of this global stuff kick off and that just shook it up a bit. And that's probably in part why we're in this sort of air pocket at the moment. It feels like middle of the year, middle of winter, people are not feeling it. So I think that will pass. But there's no doubt that if you look at some of the big drivers of the economy, they're not quite as positive as where they have been in the past cycles. So it's still going to be a bit stop-start out there, I think.
Mike Jones, lovely to talk to you. Appreciate your time.
Thanks.
Before we go, you don't want motivation, you want ammunition. Moves that work, tactics that win. The 3 property formula is the playbook smart Kiwis are already using while the rest are still refreshing Trade Me and panicking at interest rates. It's written by old mate Andrew Malcolm. No fluff, no webinars, just results from the front line. Get the strategy, own the edge, grab the book before someone else buys your future.